Here's the cheat sheet for time frames. Weekly high time frame, 4-hour low time frame, daily high time frame, 1-hour low time frame, 4-hour high time frame, 15-minute low time frame, 1-hour high time frame, 5-minute low time frame, and boom. Alright, I'm about to drop 3 order block strategies that can take your trading to the next level. Let's kick it off. Alright, let's break down what an order block actually is. An order block is a powerful zone on the chart where massive amounts of money have been traded, usually by big institutions or banks, also called smart money. Because they move with huge capital, their trades can blast prices in a clear direction. So, when you see a sudden price jump from one area, like this, it's a huge clue that smart money just stepped in. Big buy orders push prices up fast, and that exact zone becomes what we call an order block. Now, there are 2 main types. Bullish order blocks, formed when heavy buy orders drive price higher, and bearish order blocks, created when large sell orders slam it down. In this video, I'll mark bullish order blocks in blue and bearish order blocks in purple. But honestly, you can use whatever colors make sense to you. The first big difference is how they're formed. Order blocks pop up when price blasts out of one area. Sharp news, boom, that's an order block. Support and resistance, though, build up after multiple rejections. If price gets slapped down once and then again at the same level, that's when you mark it as support or resistance. The second difference is how they're drawn. Order blocks show up as thick zones, big chunks on the chart. Support and resistance, they're usually just thin lines. Even if you turn them into zones, they're still way thinner than an order block. The third difference is how they're retested. Order blocks are mostly one-time use. Price comes back once, and after that, it's dead. But support and resistance, they can be hit again and again. And here's the kicker. While they're different, they can be combined. If an order block forms right where resistance is, that's confluence. And confluence means way higher odds the price reacts huge at that spot. Before you jump into trading with order blocks, you've got to know how to spot them the right way. Sure, if price rockets away from a point, you might think that's an order block. But hold up, it's not that simple. A huge price move doesn't always equal a valid order block. There are clear rules you need to follow to know if it's the real deal. Listen up! These are the 3 absolutely essential rules for spotting a legit order block. If you don't get these down, you cannot trade this strategy successfully. Rule number 1. For any price move to count as an order block, it has to leave a gap afterward. Traders call this gap inefficiency or imbalance, but don't overthink it. It's just a gap. Let me make it super clear. Imagine 2 upward price moves. On the left, there's a clean gap between the first candle's upper wick and the third candle's lower wick. On the right, the wicks and candle bodies overlap, so there's no gap. The difference is everything. Only the left setup is valid because that gap proves inefficiency is there. And when you draw the order block, you grab the very first candle before the gap and draw a rectangle from the top wick all the way down to the bottom wick. Rule number 2. An order block must be untouched, completely unmitigated. Think of it as a one-time use level. If price touches it, even just with a wick, it's instantly invalid. No second chances. So, if you see a gap and mark your order block but the market comes back and taps it, it's dead. Yes, there are advanced tricks for reusing tested blocks, but that's for later. For now, lock this in your head. An order block can usually only be used once. Rule number 3, the biggest rule of all, an order block has to trigger a break of structure or a clear change of character afterward. No break, no order block. If you're not sure what those terms mean, don't stress. I'm about to break it down for you in the simplest way possible. Let's break this down fast. Markets move in 2 directions, uptrends or downtrends. In an uptrend, price doesn't just shoot straight up, it moves step by step, creating what we call higher highs and higher lows. Higher highs mean every new peak is higher than the last, and higher lows mean every dip is also higher than the one before. Now flip it. In a downtrend, it's the exact opposite. The market forms lower highs and lower lows. Each peak is weaker than the one before, and every low dives even lower. Here's the exciting part. In an uptrend, when price blasts above a previous high and makes a brand new one, That's a break of structure. But trends don't last forever. Eventually, the market flips. That shift happens when price smashes below a previous low and forms a lower low. That's what we call a change of character. The market switching from bullish to bearish. And it works the same way in a downtrend. Price keeps making lower highs and lower lows, and breaking past lows is a break of structure. But if price suddenly rips above a previous high and makes a higher high, that's another change of character, flipping the market back into an uptrend. So there you go. Break of structure shows continuation, change of character signals a reversal. That's the secret behind reading market trends. So how does this actually connect to order blocks? Simple. An order block only counts as valid if it leads to either a break of structure or a change of character right after. Check this out. On this chart, we see a massive upward move with a gap, also called inefficiency, which hints at a possible order block. But here's the catch. You can't just mark it right away. First, the market has to confirm by showing a break of structure or a change of character. So we wait. But the second price finally ripped above the previous high, creating a break of structure. That's when we lock in our order block on the first candle before the inefficiency. And it doesn't stop there. Later we see another powerful move up with inefficiency, and boom, the price slashes higher, breaks structure again, and confirms a brand new valid order block. Let's go over another example. On this chart, the price is climbing with higher highs and higher lows, and right here we spot a potential order block because of inefficiency. But hold up, we can't call it valid yet because price hasn't broken to a new higher high. Then, boom, the price drops and suddenly forms a possible bearish order block. Look at this big red candle. It creates a sharp downward move with inefficiency. After that, the price breaks the previous lows and forms lower lows. That break is huge. It's a full-on change of character, flipping the market from uptrend to downtrend. Now here's the key. We focus on the latest bearish order block because it lines up with the new downtrend. The earlier bullish block doesn't count since price never made higher highs, but the bearish block is solid. It's valid because it triggered the change of character. In this video, we're breaking down order blocks the simplest way possible. First, check this out. The price shoots up with huge momentum plus some inefficiency, hinting at a possible order block. But here's the catch. Since there's no break of structure yet, this block isn't valid just yet. Then boom, the price dips down, bounces back up, and creates more inefficiency, giving us another potential order block. This time, the market pushes to higher highs inside a smaller structure, which makes it valid for that setup. And if we zoom out, we see higher highs on the bigger structure too, meaning that earlier block finally becomes valid as well. So here's the deal. Order blocks depend entirely on the structure you're looking at. Let's recap the 3 rules for a valid order block. It must clear a gap, also called inefficiency or imbalance. It has to stay untested or unmitigated. And most importantly, it needs a break of structure or a change of character afterward. Master spotting means, and you're not just learning, you're gearing up to use order blocks as a powerful weapon in your trading strategy. Alright, I'm about to drop 3 order block strategies that can take your trading to the next level. Let's kick it off with strategy number 1, multi-time frame confirmation. Here's how it works. Start by spotting an order block on a higher time frame. In this case, we're using Bitcoin's 4-hour chart. We see 2 major moves, one shooting up and one crushing down. Both show inefficiencies, so we've got 2 possible order blocks, one bullish, one bearish. But hold up, we've got to check if they're actually valid. For the bullish block, the price did push upward with inefficiency, but there was no real break of structure. Plus, it already got retested, which means it's no longer unmitigated. On the flip side, the bearish block made lower lows, broke structure and stayed untouched. That makes the bearish block the valid one. Now here's the news. Wait for price to pull back into that bearish block. Once it does, it's time for confirmation. Drop down to a lower time frame like the 15-minute chart and look for bearish momentum. You can use confirmation tools like MACD, candlestick patterns, or structure shifts. Personally, I love the bearish engulfing candlestick pattern. It's simple, powerful, and crazy effective. It happens when a small bullish candle is completely swallowed by a larger bearish one, signaling reversal. As soon as you spot it, enter a sell trade, set your stop loss just above the order block, and aim for a take profit. Gets double your risk. That's where the profits stack up. Here's the cheat sheet for time frames. Weekly high time frame, 4-hour low time frame, daily high time frame, 1-hour low time frame, 4-hour high time frame, 15-minute low time frame, 1-hour high time frame, 5-minute low time frame. And boom, that's strategy number 1 locked in. Strategy 2, inducement traps. This setup is like a market prank where a smaller key level forms right near a massive order block. Picture this, you've got a major order block sitting below and right above it, a tiny key level forms. That smaller level, called the inducement, might reject the price over and over. Here's the trap. Most traders think that minor level will hold, so they buy there, but boom, the price usually smashes through that tiny level, drops back to the major order block, and then rockets the other way. All those early buyers stopped out. Here's how you flip it in your favor. When you see a minor key level above a major order block, you don't buy at the minor level. Instead, you place your buy order smack in the middle of the major block. That way, you only enter the trade if the price dips into the order block. And if it doesn't, no trade, no risk. And this isn't random. It's actually the game plan of institutions, aka smart money. They've got massive capital, so they can't just hit buy like retail traders without pushing the price way higher. To solve that, they use inducement levels. First, they build an order block. Then, they push the price down by triggering stop losses from retail traders buying at the inducement. Once those stops get hit, extra selling kicks in, giving institutions the perfect low entry. That's when they load up and price shoots back up. Let's check a real example. The price rips upward, leaves inefficiency and breaks structure. Boom, valid order block. After that pump, a support zone shows multiple rejections. That's your inducement. Since there's a major block just below, this screams inducement trap. The play? Place a limit buy in the middle of that order block and chill. The price dives down, wipes out the inducement, tags your buy, and then reverses. Now set your stop loss just under the order block. Aim for a target 2 to 3 times bigger than your stop, or even lock profits back at the inducement zone. Result? Clean, high reward win. Strategy 3. Breaker blocks. At the start of this video, I told you order blocks are usually used only once. But guess what? There's a crazy way to flip broken order blocks into profit machines, and it's called breaker blocks. So, what's a breaker block? It's basically a valid order block that gets broken by price. Once that happens, the price can shoot back up to that level, but now it's no longer support, it's resistance. And when that rejection hits, boom! That's your chance to jump into a short trade. But here's the catch. Breaker blocks usually only work once. After the break and retest, their power is gone. That's why timing is everything. Let's run through an example. The price explodes upward, leaves inefficiency and prints higher highs. Awesome! Now we mark the order block, but then, bam! The price tanks, smashes through the block and even breaks previous lows. That's not just a break, that's a change of character. The market just flipped from bullish to bearish. Now here's the magic. As the price climbs back toward that broken order block, the same level turns into a resistance zone. That's where you want to strike. You enter a short, place your stop loss just above the breaker block, and set your take profit at double the stop size. In this chart, the rejection nailed it, hit our target, and locked in a clean profit. So now you've got 3 powerhouse strategies in your toolbox. But listen, if you're brand new and this feels intense, don't stress. Start simple. To kick off your journey with order block trading, I've hooked you up with the order blocks all-in-one indicator, and trust me, this thing is a total game changer. You can load it right onto your trading platform and boom, it lights up your chart with every type of order block you need. Unmitigated, mitigated, and even breaker blocks. No more guessing, no more squinting at charts, just clean coloured boxes and labels showing you exactly where the action is, whether it's a reversal zone or a continuation setup. And here's the best part, I'm not just tossing you the indicator, I've built a full plug and play template you can drop straight into your chart, upload it once, and everything's ready instantly. No stress, no confusion, just pure trading clarity. The download link? It's right down in the description waiting for you. Now, if this video just made trading 10 times clearer or gave you that aha moment, do me one huge favour. Smash that subscribe button, ring the bell so you never miss the next insane strategy, and share this video with your crew on WhatsApp, Facebook or X. That way, you're not just leveling yourself up, you're helping your entire squad win too. Thanks for tuning in, and I'll catch you in the next video.